Welcome to Investing Path, where we bring you the latest news and insights into the world of finance and investing. Today, we will be discussing the sudden closures of three banks and the bankruptcy of Silicon Valley Bank's parent company, which has sent shockwaves through the banking industry. As you may already know, the Silicon Valley Bank was a major player in the startup ecosystem, providing funding to many of the world's most innovative and promising companies. We have been closely monitoring this situation and the fallout from these closures. The collapse of Silicon Valley Bank has left many wondering how such a well-established institution could fail so spectacularly. To understand what really happened, we must delve deeper into the history of the bank and its business model. In the early days of Silicon Valley, startups faced a unique challenge. Unlike traditional businesses, they were focused on creating cutting-edge technologies for the future rather than generating profits in the present. This made them risky bets for banks and other investors who were hesitant to loan them money. However, one man saw an opportunity in this untapped market and founded Silicon Valley Bank, which quickly became the go-to bank for startups. Over time, the bank's assets grew to over $70 billion, but there was a problem. As with all banks, Silicon Valley Bank used fractional reserve banking to generate interest by lending out the money deposited by its customers. This worked well until a crisis hit, and depositors began to withdraw their money en masse. Suddenly, the bank didn't have enough money to meet the demand, and it collapsed. So, what caused the sudden run on Silicon Valley Bank? It all started in 2020, with the outbreak of a SARS-like virus that quickly spread across the world. The resulting panic caused investors to pull their money out of the markets, including Silicon Valley Bank, which suffered a catastrophic loss of assets. Breaking news from Wall Street has just been announced. Stocks have halted trading after a 7% drop, all due to the coronavirus crisis. The government had concerns that the panic might cause irreparable damage to the economy, which could potentially be worse than the 2008 financial crisis. Therefore, the Federal Reserve, or the Fed, took swift action by slashing its benchmark interest rate. This meant that companies could borrow money for free, as zero rates gave them unprecedented access to financial resources. Moreover, the Fed injected more money into the market than we have ever created, resulting in the creation of the biggest bubble in history. But what does free money mean in this context? When companies can borrow money at such a low rate, there's no incentive to refrain from borrowing. Even if they invest that money into the S&P 500, they're likely to earn a profit, given that the market generally yields 4 or 5% returns. This created a prime opportunity for companies to borrow as much as they could. The Fed sustained 0% rates for 2 years and distributed cash to people for staying at home, leading to significant benefits for startups, which typically don't make much money but require cash to invest in future technologies. As a result, overnight, startups gained access to unparalleled amounts of money, and a large portion of these funds were deposited into Silicon Valley Bank, leading to the bank's assets soaring from $70 billion to $220 billion in less than 2 years. The companies that benefited from this policy were not only able to weather the storm, but also invest in their futures. This move by the Fed generated substantial economic growth, making it a prime opportunity for startups to secure the resources they needed to advance. It enabled them to keep the momentum going, leading to a robust innovation and allowing them to seize on the opportunities presented by the crisis. Silicon Valley Bank, a hub for these ambitious startups who began developing new technologies that would transform the future of the world. As a result, we witnessed a significant shift in economic power towards innovative, forward-thinking companies that were no longer limited by the lack of resources. As we all know, banks exist to invest the money that they hold, and that's precisely what happened when Silicon Valley Bank accumulated an enormous amount of cash during the period of zero interest rates. SVB invested in the safest investment out there, the government bonds. Moody's gave SVB an A rating, making it a trustworthy investment for everyone. However, as expected, the interest rates started to rise, and for the first time in 3 years, they raised the rates. The Federal Reserve continued its mission to curb inflation, and this meant that cheap money was no longer available. companies with weak foundation began to crumble, leading to the stock market tanking and a looming recession. But that's just one part of the problem. Let's talk about the inverse relationship between government bonds and the interest rates. When you buy a bond, you're essentially lending money to the government. In return, the government promises to return that money after a certain period, plus an agreed upon interest rate. This interest rate is set by the Federal Reserve. So, when the Federal Reserve raises interest rates, the interest rates for new bonds will also rise. The government bonds are considered to be the safest investments because they are backed by the US government. But as interest rates rise, the value of the bonds decreases. So, investors who bought bonds at a lower interest rates will lose money if they sell the bonds before the maturity date. Well, we couldn't just sit in a pile of cash, we had to invest that money. That's how banks works in the first place. So we turned around and purchased government bonds, which are the safest investments out there, for US government bonds to fail. So, Moody's, the most trustworthy rating agency, gave us an A rating, which means that everyone can trust us now. But then the expected happened. The Federal Reserve could soon raise interest rates for the first time in more than 3 years. This morning, the Federal Reserve continued its campaign to curb inflation, raising its benchmark interest rate to the 5th time. The era of cheap money was over. Whoever did not have a solid foundation began collapsing. Literally, companies with weak foundations began failing one after another. The stock market tanked, and everyone expected a recession. But that's just part of the problem. The real problem with the government bonds... Wait a second. They didn't tell us that the government bonds are the safest investments out there. Well, yes, we did. But here's the thing. Government bonds and interest rates have an inverse relationship. We know that it sounds a bit complicated, but let us explain. A bond is basically a loan. You give the government $1,000, and the government will give you a piece of a paper that says bond. The government will return you back that $1,000 plus X amount of interest in 10 years, for example. And the rate is set by the Federal Reserve. So, when the Fed raises the rates for new bonds will rise. The sudden failure of Silicon Valley banks sent shockwaves throughout the financial industry. It was the first bank failure in the United States in over a decade, and it made investors and depositors alike nervous about the stability of the banking system. The government had to step in to prevent a full-blown financial crisis. When the Fed started raising rates to curb inflation, the bubble burst, and banks like SVB were left holding a lot of toxic assets that they could no longer sell at a profit. The downgrading of SVB's credit rating was just the tip of the iceberg. As depositors started withdrawing their money, the bank's reserves were quickly depleted, and it became insolvent. The failure of SVB was a wake-up call for the financial industry and the government. It was clear that something needed to be done to prevent a repeat of the 2008 financial crisis. The government passed new regulations to ensure that banks were better capitalized and less exposed to risky assets. The Fed revised its monetary policies to be more cautious and gradual in their approach to interest rate changes. In the end, we learned an important lesson about the consequences of playing with the monetary system. The financial industry is too important to be left to the whims of the market. We need responsible regulators who can balance the needs of the economy with the stability of the banking system. Otherwise, we risk another catastrophic collapse that could cripple our economy for years to come. But for now, we thank you for watching Investing Path. We hope you found this video informative and eye-opening. It is clear that the current economic situation is a cause for concern. The pandemic has led to an unprecedented amount of money printing, and this has created a serious crisis for many banks, including SVB and Signature Bank. The fact that 190 banks are on the verge of bankruptcy is alarming, and it is clear that the banking system is under significant pressure. What's particularly worrying is that the government's solution to this crisis is simply to print more money. This may provide a short-term fix, but it is not a sustainable solution. In fact, it is only going to exacerbate the problem in the long run. As investors, it is important that we stay informed about the situation and understand the risk involved. We need to be vigilant about where we are putting our money and take steps to protect ourselves from potential losses. We hope you've enjoyed this video and found it useful. Don't forget to subscribe to our channel for more insights and analysis on the world of investing. Thanks again for watching Investing Path.